Investors are having to contend with a transformed economic background, one not seen for over 15 years. To some, this period spans their entire investment experience, and not seeing values rise each year can cause nervousness. Unfortunately, the rules of the game are that periods of weakness must be accepted to achieve longer-term rewards. Performance in portfolios has been challenging due to rising interest rates and inflationary pressure. We feel we are through the worst of the economic transition, and investors should not expect recent experiences to guide the way forward. However, economic growth will be harder to come by, and a recession remains possible. In the third quarter, we have again seen resilient market performance. The UK FTSE All-Share has risen by 1.9% for a year-to-date return of 4.5%, whilst the FTSE World ex-UK has risen by 0.6% and 9.8% year-to-date in sterling. For fixed interest, UK gilts remain negative, down 4.6%, whilst corporate bonds performed better, rising by 1.2% both year-to-date. It is important to recognise we have now passed the 12-month anniversary of former Prime Minister Liz Truss's unfunded economic growth plan in September 2022, which pushed market borrowing costs rapidly higher. Fixed interest values have largely recovered from that fall, and investors may now see increases in values in reviews over the coming year. That is, if markets believe we have passed peak interest rates, which appears to be the case, although we have seen a recent shift that rates will stay higher for longer. Central banks need to get inflation back to target, which in the US and UK is 2% annual price growth. The latest prints show US prices growing at 3.7%, but higher in the UK at 6.7% for reasons outlined in previous commentary, including a tighter labour market. We could see further modest rate rises if inflation does not fall back to target, and added pressure may now come from the recent onset of war in the Middle East and the potential disruption to energy markets. We appreciate in a challenging environment that returns available from cash accounts may seem attractive right now, but a long history of investment returns should provide confidence that real assets such as equities and property, but also fixed interest, provide greater protection against inflation given a sufficient holding period.